You were posing before the commercial break about financials right now because they have been hit the hardest during yesterday's sell-off, with banks now helping to drag the sector down. Joining us now for a little bit of an in-depth look at where this is all headed in financials, Jeff Harte, principal at Sandler O'Neill. Why would you want to own a bank right now, Jeff?
Yeah, it's been a tough tape for banks, with unfortunately macro justification, right? I mean, banks kind of provide the lubrication for the economy. There's economic concerns. The yield curve is inverted. Historically, that's not been a good omen for how things are going to play out. And really, it's just tough for financials in general. When you've got a 10-year yield under 2%, pretty much all the spread businesses are under pressure. So it's been tough for financials, but that tough environment could keep ticking on for a while here. So as I kind of look at the group, it's tough to say, hey, this is a blanket buy. They've so far underperformed. You need to buy banks in general right now. But I do think if you look for there are some attractive valuations out there and some companies I think it is worth looking at in the financial space.
Okay, so who do you like?
I specifically like places where you can buy a good bank for a really low valuation. The name that comes to mind is Citigroup. That's one of the few trading south of tangible book value, and at 7.5 times the forward estimate. I mean, that's a 3 multiple discount to the peer group. I also like banks where you can have kind of large buybacks, relatively speaking, or high dividend payout yields. There's a lot of 3% plus dividend yielding banks out there that are attractive. But again, you look at Citigroup, I think they're going to buy back almost 15% of their market cap this year. B of A is in the same boat. I think kind of some of those big names are ones you can look at and be adding to safely here.
Jeff, do you think that there's going to be merger activity in the community banking sector or the smaller banks as a result of what's going on?
Yeah, I mean, I think the general long-term trend is we're going to see consolidation. Generally speaking, we have too many small banks for the country. So I think that trend will continue. But anything that makes the operating environment tougher, I think, probably helps to be a catalyst there, right? At first, we had some of the regulatory expenses. It just became tougher, and that kind of spurred a bunch of M&A. And I think the longer the revenue environment stays tough, the more accelerated we'll see that M&A kind of in the community bank space continue.
Jeff,
or pick up.
J.P. Morgan and Tom was talking about Jamie Dimon. Jamie Dimon's on his bus tour this week. You want to own J.P. Morgan, given what's going on, and is it priced for perfection?
Well, you know, looking at J.P. Morgan versus the market or versus bank stocks, I want to own it. But we do have a hold on it, and that's because the companies we're comparing it to, and I mentioned B of A and Citigroup, it's more priced for perfection than some of its larger peers. So relative to the universal banks, it's on our hold list. But if you're just kind of looking at versus banks in general, J.P. Morgan's probably the best managed. They have the same advantages that kind of a Citi and B of A have. It's just they're already getting a bit of a premium multiple versus a Citi and B of A.
Where do you place a Goldman Sachs, especially on a week now where its credit card is launching? I think there's going to be a huge opportunity for that credit card. I mean, they may not get any real margin out of it in the short term, but I think the platform they can create off that could be material. It may take a couple of years.
Yeah, I mean, I think outside of just the ability to grow loans, remember, they got a lot of deposits that they need to put to work. So to the extent they can grow loans, that's good for earnings. But also just kind of the connections to consumers and some of the technology side of it, I think gives them some advantages. The thing with Goldman is, and we have a buy on it, I do like it here, but it's a little bit of a wait and see. We need to see kind of what the 1MBD settlement really turns out to be, get that behind us, and kind of get a more granular update on some of their strategic priorities, which we're supposed to get kind of as we get into early part of next year. So especially if capital markets cooperate, which lower rates should help with, I like Goldman here, but you know, I think it's one you can kind of pick and choose your times to get into.
What is the upside scenario for these financial stocks? I mean, they're all down from January 1 of 18, but not down too dramatically in a really lousy environment. So maybe the market's saying there's some hope. What is the hope?
Well, I think some of the sell-off we've seen recently, I mean, look at what the 10-year's done. That's really weighed on the banks. But the 10-year's moved to, 1.7%. Doesn't look like, I mean, it looks like panicked buying. It looks like the market is just kind of running and hiding to the extent that U.S., China actually kind of come to some kind of agreement on trade. We don't come into a recession. I mean, I think a lot of bad things are priced in right now. They're not going to clear up overnight, but a lot of kind of, I think, panic-type bad things are priced in. If you give me an environment where GDP growth continues, the kind of trade fears fall off a bit, Brexit kind of gets worked out reasonably, and capital markets are good for some of these big banks, yeah, you could see a lot of upside in the next year.
Okay. We're going to leave the conversation there. Jeff, thank you. Appreciate your time this morning. especially on such a wild one when it comes to these banks.